welcome to the third in this series of IMAP webinars on alternatives. Sky-high markets, rock-bottom interest rates. Is there really any alternative to using alternatives in portfolios? In the first two sessions of this series, we've looked at alternatives for the growth portion of the portfolio, and then on Wednesday, we've looked at alternatives to the defensive asset classes. Today, we're going to try and draw that together and look at the way in which leading portfolio managers, Morningstar, Lonsec, and Zenith, utilize alternatives or not in the way they think about managed account portfolios. I'll leave Daniel Stojanovski, our moderator, to talk to us today about the session. But before I hand over to Daniel, let me just say a little about three upcoming events for the rest of this year. Later this month, we'll be announcing the winners of the IMAP Awards for 2021. And I'd encourage you to join the webinar. Unfortunately, we won't be doing that live as we'd hoped, because we're all, like you, suffering from COVID overload. In September, we'll be announcing, or we'll be releasing our June 2021 fund census, and then together with Milliman's and Praemium, we'll be looking at the state of managed accounts. In December of 2020, managed accounts stood at about $95 billion. So have they gone through 100 billion? And what does this tell us about the usage of managed accounts? And then in November, we'll be introducing the first of a new series for us called Independent Thought, the opportunity to showcase the role and thinking of portfolio managers like Daniel from Centrepoint Alliance, those who are, to my mind, at the cutting edge of the way in which managed accounts are delivered. The portfolio managers and their consultants who develop portfolios for use by advisors. Now it's my pleasure to hand over to Daniel Stojanovski to introduce today's session and to get us underway. Daniel, thanks very much.
Thank you, Toby, and thank you for having me in moderating now this third and final session that we have. Just before I get started, just a quick general, I guess, housekeeping in terms of asking questions. At the bottom of the Zoom page, you'll notice a Q&A icon. Just click that and ask any questions in there, and hopefully either the speakers or myself will be able to see it and get to it towards the end of the session or within the session. So that'll be great. And in terms of today's session, and as Toby had mentioned, we have been running three unique sessions on alternatives this week. The first on Monday covered really that growth-like alternatives and alternatives to growth assets. The second session focused on defensive alternatives, specifically around those strategies in the defensive space, alternatives to duration, income, and the like. And this follows on to our final and last session today, which basically will bring it all together with some of the large research houses, Morningstar, Lonsec, and Zenith, around portfolio construction and just a broader discussion around that alternatives piece. Now, as mentioned over the last few days, in terms of how this is approached from a Centrepoint research sort of perspective, alternatives at the end of the day, from the growth side, when we were focusing on growth-like alternatives, what they're doing is really protecting against equity beta risk, while obviously reducing the correlation to equity-like assets. And then in the defensive space, broadly sitting within fixed income, they're there to protect against the duration element of the portfolio in more defensive-like alternatives, specifically income, and obviously lowering the correlation to those traditional types of fixed income. So without further ado, let me introduce the speakers for today's session, who will help us get a better understanding of what their own house views are in their respective firms, and then obviously looking at more that portfolio construction. I'd like to introduce firstly Deanne Baker from Lonsec. Deanne joined Lonsec as a portfolio manager in late 2019 and is responsible for the management of Lonsec's multi-asset and retirement portfolios. Deanne has been with Lonsec since July 2007 and holds over 20 years experience in managed funds research and portfolio management. Thank you. Hi, Deanne. The second speaker today is Stephen Tang from Zenith Investment Partners. So Stephen joined Zenith as an investment analyst within the fund manager research team before moving across into consulting in 2015. Stephen spent almost 8 years conducting manager reviews across a broad range of asset classes, both domestically and around the globe. And in early 2019, he was appointed the head of consulting, taking oversight over the team and the investment process there at Zenith. And lastly, our last speaker is Tim Murphy. So Tim Murphy is a director of Asia Pacific Manager Research for Morningstar. He's director of Asia Pacific Manager Research at Morningstar, sorry. He's responsible for leading qualitative research on managed funds, exchange traded funds, and listed investment companies, as well as managing Morningstar's model portfolios and relationships with consulting and advisor clients around the APAC region. So thank you to all the speakers for today. So how we might start this off, similar to the other sort of sessions, is get the speakers to really go through their approach to alternatives and way they build portfolios, the role and portfolio construction, and then have a broader discussion around the topic thereafter. So I'll just hand it off to Deanne to start us off, and we'll take it from there.
That's great. Thanks for that, Daniel. And thanks to IMAP for having me on today's panel as well. At Lonsec, we do believe there is a strong case for including alternatives within a multi-asset portfolio. And there are a number of reasons we think that. The first one is obviously diversification. We do believe that adding lowly correlated return sources can improve those risk-adjusted returns of your portfolio. Second one is that we think it can provide access to alternative risk premia. And that's risk premia that's not readily available in your traditional asset classes. Could be things like the illiquidity premia, that reward for taking on a liquidity risk. And we think that's important in a world where traditional risk premia, such as that you get from equities and bonds, is expensive by historical standards. Alternatives also provide that access to manager skill, meaning that you are less reliant on the direction of markets to drive your returns. And finally, alternatives can play a good role in reducing portfolio risk. And that's critically important when traditional risk diversifiers such as bonds are not offering the portfolio protection they once did. If we could just move forward to the next slide, please. In our multi-asset portfolios, the allocation to alternatives ranges from about 12% in our defensive options, and it goes all the way up to about 19% in our high growth portfolio. So it really is a meaningful part of our asset allocation. What it does mean is that we tend to lag our multi-asset peers in strong equity market rallies. Most alternatives are just not designed to keep pace with raging equity bull markets. But over the cycle, it does mean that we do tend to deliver, stronger risk-adjusted returns. We certainly acknowledge that there are additional risks associated with investing in alternatives. Such risks include reduced transparency, added complexity, high use of leverage, and sometimes illiquidity as well. So it really is important to have good quality research that can help you identify the risks that are specific to the strategy you're considering, and to really ensure that you're only investing where that risk is likely to be rewarded. We could move to the next slide, please. When it does come to building an alternatives portfolio, we tend to build a very different alternatives portfolio for a conservative investor compared to a high growth investor. They do have different investment time horizons. They have different risk tolerances and also different beta risks within the portfolio that need to be managed. So we really focus on customizing the solution to fit the specific risk profile need and complement the existing exposures within the broader portfolio. Just moving to the next slide, please. So at Lonsec, we define alternatives as products that provide alternative source of risk and return to those derived from traditional assets. Now, typically these assets are lowly correlated with traditional assets, but not always. It is a very heterogeneous sector, as I'm sure you've discovered earlier during the week, and does include a wide range of investment strategies. But for us, they do mostly tend to fall under hedge funds, private markets, and commodities as broad subsectors, I guess. We do have 3 buckets, and we start by grouping products based on their volatility. Obviously, volatility is just one measure of risk, but it does serve to provide a starting point for us and set up some of the broad pools from which we can fish in as portfolio constructors. Conservative alternatives, those are the strategies that do tend to have bond-like volatility, below 4%. Things like relative value, maybe some of the private debt and credit strategies would fall into that space. Moving up the risk spectrum are our growth moderate strategies. And those strategies tend to have about 4 to 10% volatility. And we'd include in that category things like global macro, market neutral, or systematic risk premium. So that more those mid-risk kind of assets there. And at the high growth end, we're talking about strategies there that tend to have equity market-like risk. Things like private equity, trend following, and FX. Outside of the alternative sector, we'd also consider what we would call alternatives to alternatives. And they're strategies that may share similarities to hedge funds. For example, they might have a degree of flexibility in terms of asset allocation. They might use extensive use of derivatives. They might do some short selling. So we'd include here some strategies such as multi-asset real return, unconstrained bond funds, and alternative income high, which includes some of the high yielding credit strategies. So we do have quite a broad pool of strategies to choose from. Now, volatility is obviously a good measure of risk, but it tells you nothing about how a strategy will perform at various points in the cycle. And it tells you nothing also about how it will interact with other assets in your portfolio and whether it's actually adding to your portfolio risk or reducing your portfolio risk. So if we move to the next slide, the next thing we do is consider the role of the role the strategy will play in a portfolio. Look, there's no panacea. There's no alternative asset that can perform well across all market conditions. They're all very different. So it is important to set very clear expectations as to what each strategy is expected to deliver and the particular role they'll play in your portfolio. And to do this, we look at correlations. We look at the medium to long-term correlations of a strategy has with the other assets in our portfolio. And we also look at the correlation of the strategies under a range of different macro environments, whether that be stressed equity markets, whether it be periods of rising inflation, periods of rising volatility, etc. And that's important because correlations, as we know, are not static and do change over time. For our return generators, there we're looking for strategies that have the ability to grow the portfolio by accessing that risk premium that's not available in traditional assets. So these assets might be positively correlated to equities. That is, they do go up when equity markets go up. So that's, again, coming back to the illiquidity premium you might see in private equity. It could also be things like select opportunities in higher yield and credit. The role of diversifiers in the portfolio is really to provide that lowly correlated source of returns to the major risks in your portfolio over the cycle. Now, these strategies can't necessarily be relied on to provide protection in risk-off environments, but they do provide that diversified return source across the full market cycle. And the final bucket we look at is that really risk control or risk mitigation bucket. And then we're trying to mitigate the most important risks our portfolio might be exposed to. And these strategies are negatively correlated to the major risks in your portfolio. And that's when you need them most in particular. So for a growth portfolio, that tends to be equity market risk that you'd be most concerned about. So there we're looking for strategies that perform well when equity markets are stressed. And there's not a lot of assets or strategies that can do that. But some that do include things like gold, perhaps trend following, and FX. I will finish up there as I have come up against my time limit there. But hopefully that's provided a bit of flavour about how we think about alternatives at Lonsec. And I'll pass back to Daniel. Thank you.
Thank you, Deanne. That was great. I might get Tim to take us through next.
Well, good afternoon, everyone. Thanks for joining us. Now, I contemplated putting together a big slide deck today, like the others have, to talk about it's obviously a very important topic on alternatives, except those of you that are users of Morningstar's approach to model portfolios would know that we have exactly zero allocation to alternatives, and therefore there'd be nothing to put on the slide. So I'm just going to, I don't have any slides therefore. I'm just going to talk to some of our high level thinking about why, maybe we're the contrarian that has not bought the alternatives story in portfolio construction for Australian portfolios to date. So if you think about portfolio construction in its most basic, back to step one, right? What are we looking to do when we construct portfolios? Obviously, as Deanne touched on, you want diversification across different assets. You want preferably uncorrelated assets across the portfolio that are going to behave in different environments. Ideally, you want some sort of downside protection cushions within that, so that as you go through a cycle and inevitably hit bumps, that you have ways of protecting some of that downside along the way, because we all know that behaviorally clients experience more pain from a drawdown than they experience joy from an equivalent uptick. So certainly the path of returns through a cycle is certainly important in thinking about how to build portfolios, so that you get clients along for the journey and not panicking and making the wrong decisions to sell out at the wrong time after a drawdown, which we tend to see fairly consistently in a lot of that sort of behavior in data that we track and measure. You want assets that are still additive to the portfolio, importantly, over time. So whether that's through adding to return, or whether that's sort of reducing risk, I think that's a really important, that each individual asset must be ticking at least one of those boxes to play a role in earning its place in a portfolio over time. And so when you combine those sort of key overarching issues, to then think about, all right, well, Wayne, what do we do to build a portfolio that meets all those criteria? You sort of then think about some of those second order effects. So particularly the correlation one is an interesting debate, right? So everyone talks about wanting to have uncorrelated assets, but no one cares about correlation on the way up, right? When equity markets are going up, then who doesn't want to be correlated to that, whether it's in equities or anything else? The trick, of course, is everyone worries about correlation on the downside. So we spend a lot of time thinking about conditional correlation of assets. In particular, the bear market correlation performance of various assets, because no one cares if you're correlated with equities when equity markets are going up, of course. And the challenge, of course, with that when building a portfolio through the cycle is that markets tend to go up over time. That's just an historical fact. So if you accept that, then you're really thinking about your conditional correlation of different assets to play a role in a portfolio becomes important. And so we then get to you've got equities, you've got bonds, you've got cash, you've got alternatives that you're here to talk about today, obviously. And I think in theory, a lot of the promises of alternatives sound great, and who doesn't want to have more assets in a portfolio that aren't correlated to equities, particularly in a down market, that offer diversification and that do add some returns and manage a skill. It's it sounds like a great idea and a great promise, but unfortunately in Australia, the vast majority of investable funds for everyone on this call that have to be Australian domiciled, usually daily priced unit trusts offered under a PDS that sit on a platform. I think most of you would know and agree that the experience of alternative funds that meet those criteria have by and large been very disappointing. And not only have the outcomes been disappointing, but equally too, often you're paying expensive prices for the privilege of lots of this. And so given that sort of disappointing experience, combined in an environment where all of us are focusing more and more on fees, and that's certainly a big increasingly seeing that, with whether that's regulatory driven or whether that's behavioral empirical evidence driven, it's very hard to make a case that the investable pool of Australian domiciled alternative funds for the most part has much of a role to play in portfolios to meet those criteria. And so our view has long been that there is zero allocation to alternatives in our strategic asset allocation, and so you would never have seen in our model portfolios any allocation or any dedicated allocation to alternatives as a result of that. So one point I will pick up on, though, in relation to that, and Deanne mentioned, illiquid assets, and I think there's definitely evidence out there of illiquidity premiums. You see that through the performance of some of the larger industry super funds. You see that through a couple of funds that are prominently available in the advisor channels here. I think given the focus on managed accounts, clearly using funds with less liquid underlying characteristics is problematic in a managed account context. So realistically, that's not practical, even if you wanted to do that. And it's certainly not scalable across a large client base, even if you're doing that outside of a managed account construct. So I do think illiquid assets is somewhat a sort of separate issue to that. It certainly isn't really practical in our view in a managed account context. So, what are the alternatives to alternatives then? This is probably the way I like to coin it. So, how do we think about portfolio construction and meeting some of those criteria of uncorrelation and downside protection and diversification? A couple of things that we think about that, in particular, we think play a role is currency exposure. Many of you would note that for the last 10 years, we have had very high allocations in our portfolios to unhedged global equities. Back when that was very unpopular 10 years ago, and then for the last 5 years, it's obviously been very popular, given the return experience there. And the return experience of that has been great, but a big part of the reason why we have that is because the downside cushion, which you essentially get for free from offshore currency exposure as an Aussie dollar investor. So one of the lucky country where we've got a pro-cyclical currency. It's a risk-on, risk-off currency, and in periods of risk-off over time, the Aussie dollar has tended to sell off quite materially, and that has repeatedly been the case over time. And so where you've got exposure to that, that has provided a meaningful cushion and downside protection in risk-off environments. We saw that, if we think about the most material drawdowns in markets of the last 15 years, during COVID period of last year, we saw the Aussie dollar fall rapidly from 70 to 55 US cents. And then back in the GFC, again, we saw the Aussie dollar fall from above 90, down to low 60s in a fairly short space of time, which as equity markets were selling off heavily and you were seeing big drawdowns, in your risk assets, that was sort of providing some of that downside protection, in particular in that risk-off environment. So there's a real bear market correlation story there for offshore currency exposure as an Aussie dollar investor, which, if you're getting that through global equity exposure, which you're taking already, from a fee perspective, you're actually getting that essentially for free. Beyond that, we still continue to think that traditional bonds have a role to play in portfolios. There's been much talk, it feels like for the last 7 or 8 years, we've been sitting here going, bond yields are at historic lows. Yields can only go up, therefore, why would you own bonds? That, of course, has been largely wrong continuously for most of that period. Certainly, we wouldn't be sitting here saying that, buying government bonds at, yields on 120, 130, depending on which market and tenure you're looking at. So those sort of the numbers on some of the 10-year stuff at the moment, from a return perspective, doesn't look exciting. But certainly, those bonds have continued to play a role in having strong characteristics in risk-off markets, and you saw that again most recently in the COVID drawdowns of last year. So that's as much as protecting some of that downside through the cycle when you get the inevitable pullbacks that you tend to do. So that's a bit how some of the things we think about alternatives to alternatives. Turn it back to Daniel now and move on.
Thank you, Tim. That was great. And I'll introduce, get Stephen to come up next and take us through his slide.
Thanks, Daniel. Interesting going at the end of 2 speakers. So I will concur with a little bit of Deanne and sort of address some of the points that Tim has made. So from our perspective at Zenith, I think before we start on the alternatives discussion, it is important that any allocation is in the context of what you're trying to achieve in a portfolio sense. And realistically at Zenith, what we're trying to achieve, if you just go one more slide, I'm sure everyone wants to read our disclaimer. What we're trying to achieve is really superior risk-adjusted returns and more consistent outcomes, and provide that stronger downside protection when traditional markets are poor. And really that comes down to some of what Tim just said, is that, loss aversion is in investors is quite key. So what you want to try and provide is that protection on the downside so that investors stay the course, but more so that, if you give risk adjusted returns, as you can see in the chart there, over the long term, you're actually much better off by, yes, acknowledging what Deanne said, is that you're not expected to participate as fully in a market upturn, but if you protect on the downside, your returns over the long term are far better from a risk adjusted perspective, but from a dollar perspective. So you're actually better off, making your clients better off in terms of overall if you provide those. And that's the context that is important. So if we just go to the next slide for a sec. Is why that we are advocates for alternatives, strategies in portfolio. It's not so much because we believe in alternatives in themselves, but it's really in what they can provide from a portfolio context and how you can provide that downside protection. As Deanne and Tim have just said, there's no panacea to providing those sort of returns. So you can't rely on any one asset class to do that. You have to have multiple levers because you just don't know how markets will behave in certain scenarios. And so this is part of that solution, and that's why we believe in alternatives. So we do believe that they can provide portfolio diversification. They're lowering portfolio and enhancing those long-term returns, as you saw in that chart. We're trying to achieve that outcome. The key for us is that we do fund them from growth assets. So Deanne touched on the fact that they look at it, from 3 different angles. From our perspective at Zenith, we really fund them from growth assets, and that's really to be conservative from our point of view. So it does pose one of a challenge that I'll touch on in a sec. So if we just go down one slide. Oops, no, go back up one slide. I think we should. Yep. So just to clarify what we at Zenith classify as alternatives, and this goes down to sort of probably the Kai definition of how you define alternatives is really inclusion exclusion. And so, we include in alternatives, we include hedge funds, and they include managed futures, global macro, and market neutrals as some example, private equity, real assets, and hard commodities. As Tim touched on, though, it's really hard to get non-liquid, daily liquid product into managed accounts. So that's a consideration when you can, thinking about real assets. It's pretty hard to get that into a managed account. What we do exclude, though, is unconstrained fixed income. So on Wednesday, you heard from Macquarie and Ardea, and we wouldn't consider them alternatives. So we can classify them as unconstrained fixed income and don't put them in that bucket. We also don't put long short equities, and some people do. So some people would put long short equities into that bucket, but we at Zenith don't classify them. There are some caveats to that, but on the whole, that's the reality for us. And the other one is listed property and infrastructure, which we don't classify as alternatives at all. We just go down another slide. So as Tim acknowledged and we acknowledged, there are some key challenges to allocating to alternatives. I touched on one before, which is that funding question, and Deanne sort of outlined their 3 ways, but we do it from a growth setting. So that does pose some challenges because in effect, you're taking it away from shares, as Tim said, and markets do tend to go up over the long term. But we do think that these assets should keep pace with equities over the long term. Remembering that these are not going to keep pace in a strong bull market where your equities are delivering double-digit or even more. These type of strategies typically aren't going to keep up in that environment. And we acknowledge that. The other aspect is the fees. So fees are a challenge. So certainly when you're building cost or fee focused or conscious portfolios, that does pose a challenge because they do tend to take up a fair bit of the fee budget. Having said that, those fees have been coming down like all other fees. We have seen compression in those fees, but you're certainly not getting down to the levels that other you've seen in certain other funds. Just go down one slide. This one is one of the key challenges, though, and does lead to a lot of questions, from clients. Heterogeneity just speaks to the fact that even within a sub-asset class, you tend not to get performance that's consistent. So, if you allocate to large cap Australian equities, you tend to get a pretty tight dispersion of outcomes, notwithstanding some outliers. But when it comes to these type of strategies, you can really get varied performance, depending on the environment they're in. So they're not all the same. So that really does speak to the fact that you really need to sort of do your DD and understand sort of what's driving these type of strategies, which poses the next problem, which is, we go down to the next slide for which is transparency. And we do get a lot of feedback on this, which is one of the key challenges of alternatives is the fact that, you don't necessarily get the same disclosure as you do at an equity fund. And that does pose some problems, but we don't think that's an impediment to allocating to these type of strategies, and nor should it be from a client perspective. Understanding what's under the hood, you can do this in multiple ways, but clearly, we're all from a research background and research houses. We have teams that are out there doing very detailed DD on these types of strategies. Not only that, but we actually look, and can quantitatively look at how they perform in different market environments, and potentially how they might perform in sort of different market environments. You can see here, this is an example of the rolling beta to equities, which is clearly something that you want to have a low beta if you're trying to diversify your portfolios, or directionally, you basically don't want them to be going down, but you have seen the beta of these type of strategies go up over time, or more recently, and that played out so more recently in the COVID experience. But that's something to be aware of, so that you can actually break these strategies down and understand sort of how they might perform in different market environments. So it's not, certainly we don't think, an impediment to allocating to these type of strategies. So in closing, we definitely believe that alternatives have a place in portfolios, and it is in that context, though, of what that we're trying to achieve that we allocate to our alternatives. Thanks. I'll pass it back to Daniel.
Thank you, Stephen. I think I'll invite everyone for us to start our discussion on this, which I think will be quite interesting. Looking at, or having listened to all three of you, we've discussed, how each group is obviously classifying alternatives, where they sit roughly in a portfolio, where they don't sit in general. But what I might start with is potentially around, I guess, in the economic environment that we're currently in, record breaking equity markets, the lowest yields from a fixed interest in recorded history, and potentially looming inflation and inflationary pressures. What strategies in portfolios in general in this space, or broadly towards your view, really fit in portfolios? Maybe Deanne, if you wanted to start us off.
Yeah, look, we agree. I mean, most of the major asset classes are very expensive at the moment. So, you do have to look elsewhere to take some risk. Some of the opportunities we're liking at the moment are in the global macro space. We certainly think that COVID has thrown up some good opportunities in global macro. Different countries are opening up at different speeds. They're implementing different fiscal and different monetary policies, which is leading to quite a wide dispersion in economic performance across different countries, and within countries, different asset classes. So macro managers really rely on that dispersion in and across asset classes to be able to deliver returns. And they tend to be quite good at trading around these kind of policy settings as well. So we're quite positive on macro. The other space we're quite positive on is more market neutral strategies as well. Similar to global macro, they do tend to benefit when stock dispersion widens. So when there's a big gap between winners and losers, and again, COVID threw up some great opportunities for market neutral managers. We saw things like airports, really big losers, and we saw some great winners into like the tech space, for example, which did really well when we were working from home and moved online. So anywhere widening dispersion is happening, it is the place we're kind of most excited about at the moment.
Great. Tim, your view on this one?
Yeah, so I mean, you'd be hard pressed to argue that on traditional value metrics in isolation that, most assets don't look expensive, but I guess that's where, as much as anything, it becomes a relative conversation, right? So money needs to go somewhere, so you can get various debates about that, because you could have sat here every year for the last 5 years and said bonds are at yields are at historical lows, they've never been so expensive, and that equity markets look expensive, and you could have sat in all in cash, or you could have sat all in alternatives, and you would have had a very ugly last 5 years experience, right? So we're not big believers, we're not believers at all in trying to take holistic views that everything's overvalued, therefore you have to be out, so to speak. So certainly our go forward capital market assumptions for major asset classes are not as high as what they were 3 years ago, but we still believe that exposure to core equity markets through time, if you're setting a medium to long-term strategy for your clients, this is obviously where the client's own objectives and risk tolerance and time frame obviously becomes important. But if you are setting a medium-term time frame for that, then core exposure to your traditional assets is still going to play that role, we believe. And a lot of this is just around then how you, attempt to massage the path of those returns, as I touched on earlier.
And just quickly, Tim, on that one, more, I guess, on the defensive space, like given, Morningstar, I'm quite used to in terms of as well, how Morningstar are viewing it, but just around that defensive space, is it not just bonds as the main thing? Is there anything else that you're looking for within fixed income in general that is alternative, I guess, to bonds?
Yeah, so it's like similar to Stephen, into thinking about that unconstrained fixed interest universe, which we'd agree we don't consider that to be alternatives, either. So, we're definitely in our more conservative portfolios. We have allocations to traditional bonds, as I referenced. We also have allocations to meaningful allocations to cash as part of that. But equally too, we do have or have had increasing exposure to some of the more unconstrained type of mandates, both local and global, that are out there as well. I think we definitely have a preference for some of the more diversified offerings in that space, more so than some that are probably just been pure or close to pure credit plays that have some pretty good trailing returns if you sit here right now, given particularly since April of last year, what credit spreads have done and how far they've contracted. But we certainly think it's really important to be conscious of any credit risk that you've got under the hood in your conservative portfolios, for sure. Because there's a lot of that's why there's a lot of risk sitting there.
No, agreed. Stephen, your thoughts on this one as well?
Yeah, so I concur similarly with Deanne about the opportunities thrown up from COVID in those particular spaces. I mean, the key challenge for anything is that you have to be forward-looking, and the reality is that none of us know what's going to happen in the future. So, we try and diversify across different strategies, similar to what Deanne said in the actual her presentation. We're not trying to say what's going to happen in markets tomorrow, because if you tried that, you would have been wrong in COVID, you would have been wrong in the rebound. And the reality is, so we're trying to diversify across different strategies. To Tim's point, we don't classify unconstrained fixed income in our alternatives category, but we have a lot of allocations to that space. Similar to Tim, you've got to be aware that a lot of them are credit orientated, but Ardea is a perfect example of a fund that did very well in sort of more recent times because of the dispersion that happened in markets and outperformed traditional fixed income managers. So, certainly we've got allocations there as well.
Right. I think in terms of a question that's been, I guess it constantly pops up in more, just to touch on briefly, more that responsible investing or ESG space. There is an approach where you can have exposure to alternatives in that space, but then I guess the question is, how do you really look at that space just from a portfolio construction perspective, having alternatives that might not technically be ESG or very responsible in terms of how they're done, or how you can even measure that? Is there any, just briefly, a view that anyone has on that, specifically around those types of portfolios? Maybe Deanne, maybe start us off there.
Jump in there, Daniel. So we've recently developed a sustainable portfolio, actually, and so looking through an alternatives lens of something we did take into consideration when building that portfolio, and to this point we haven't been able to get comfortable around a specific ESG or sustainable strategy within the alternatives space. We've had quite a lot of managers coming to market recently claiming to be, sustainable or having ESG integration into their alternative strategy. But for us, we're really yet to see, that really embed itself into portfolios, where there's some of the opportunities that are starting to look promising, perhaps, but we're still a bit too early, maybe in the private equity space. And perhaps global macro as well. But, really it comes down to, how do you view derivatives? Are they ESG? There's a whole range of issues that we haven't got enough comfort around yet to include alternatives in our sustainable portfolios.
Stephen?
So from our view, similar to Dan, from our perspective, it's very hard generally to put alternatives into a sustainable portfolio. Our research team, similar to Lonsec and I'm sure Morningstar, have gone through and sort of applied ratings, qualitative ratings to these strategies. Most of them would fall in the sort of lower categories, either traditional, not taking that into account, or aware. It's very hard to get anything above that in terms of the categorization. So Similarly, when you consider it from a portfolio context, it's pretty hard to justify at the moment, at least to putting them into a portfolio if that is your main sort of consideration.
And Tim, just on that, just briefly, I guess, on a managed research perspective.
Yeah, obviously we in our ESG models we don't have any because we don't have any alts in any of our models, as I said. So that's easy. But yeah, again, on the ratings front, there's a handful of products in the alt space trying to claim ESG credentials in there. Nothing that we would really rubber stamp and say is doing a standout job or really has strong ESG credentials along with strong qualitative criteria. So slim pickings at this point.
I think that I just might get one of the questions that have just been sent through to us to the panelists actually. In terms of the question is, where do the panelists sit in terms of diversifying between alternatives? Do you run risks around tax inefficiencies or doing so single wrapper, or how do you really rate multi-alternative options that are coming into the market in general? Stephen, maybe to start us off.
Sorry, Dan, can you repeat the question? Sorry, in terms of what you...
Basically, the question was, so where do the panelists sit on diversifying between alternatives, specifically around how you rate multi-alternative options that are coming onto the market?
Yeah, so if I'm reading that question correctly, is as I mentioned, we do diversify across multiple strategies too, and have looked very carefully, which it was on Wednesday. The Janus Henderson fund is actually an allocation within our portfolios these days, and so that we certainly think that's an advantage from our perspective, from Zenith perspective at least. The advantage of the Janus Henderson fund typically, or historically, the difficulty with those type of strategies is that they allocate to external teams. Whereas in that Janus Henderson fund, it's all internally managed, which is a positive from our view, and provides sort of even further diversification to the strategy. So we do see that as a positive.
In terms of Tim or Deanne, just on that, your thoughts?
Look, we agree with Stephen. We believe in diversifying across our alternative strategies as well, and multi-strats play a role in our portfolio as well. Look, it does comes down to how the strategies correlate with each other. We don't want two multi-strats doing the same thing if we were to include two multi-strats, for example. So it really is just about having different strategies that either access different underlying strategies, whether it be event-driven or market neutral, or a range of different underlying strategies that bring something different to the portfolio.
And Tim, on that one, same your thoughts?
Yeah, I mean, look, if you're going to use alts in your portfolio, obviously using a multi-strategy approach brings some diversification that a single strategy might not, which, given in most cases I've observed, people aren't generally using more than probably two funds in this sector in a portfolio overall. I can see how that might be important, but if I look at some of the larger, more prominent diversified alternative funds that have been used in recent years, the experience has been a little disappointing, to say the least.
And just on that in general, in terms of getting all three of your opinions on this one, is how do you determine when a strategy has actually failed in this space? When's best to pull the pin? What are the sort of the metrics around that, and how should there be sort of controls in terms of what people are looking at with managers in this space? Stephen?
Yeah, okay. That's always a difficult question, but it does come down to two sort of elements as we've discussed. It is, there's a portfolio context. Is it playing the role that you expect it to in the actual portfolio? And secondly, is it hitting its objectives more broadly from a fund perspective? It is an interesting question because we get asked that quite a lot from the client base in terms of, alternatives have had a more difficult period of performance, to Tim's point. Like, there are a lot of funds that haven't performed well. And certainly you need to look at and understand sort of the environment they've been in and what might be causing that. There could be an environment now that's not suitable to that style of investing, which, therefore you wouldn't want to shoot something just because the style hasn't been in favor. But certainly so there's no magic bullet that we look at and say, okay, we're going to cut it. But certainly we're looking at it from a portfolio perspective, whether it's played its role and whether or not it's hit its targets. And does that make any sense in the context of the environment we've been in?
I think the only thing I'd add there is I agree with everything Stephen said. The only thing we'd probably add is that, you know, if it's not, if we start to see some style drift as well, you know, if we start to see a manager that's meant to be lowly correlated to perhaps our equity book and we start to see beta creeping into the portfolio, that would be certainly a concern for us as well.
Yeah, I mean, the only thing I'd add, I think it's conditional on the type of strategy, right? So I think what Stephen said in terms of, you know, the role in a portfolio and style drift and whatnot applies for a single strategy. But if you're talking about a sort of multi-strategy fund, like, isn't that what you're paying the multi-strategy manager to do? So I wouldn't, that in my mind should not be too environment dependent, I would have thought. Otherwise, what are you paying them for?
And just on that, from a portfolio perspective, in terms of the risks, are you seeing more risk being taken by, I guess, clients in general around this space, given that, you know, we have private equity and that illiquidity risk, and obviously it keeps on increasing at times, and obviously the hunt for yield and the like, you know, private equity, private debt. Do you see concerns and things like that, I guess, with portfolios in general? Maybe Deanne?
Yeah, I think like private market investing is really, really taking off, particularly in the retail space over the last 12, 18 months. You know, we're seeing a lot of products come to market, whether that be listed vehicles or you know, traditional kind of managed fund style. So it's certainly becoming more popular. And I think, you know, investors are certainly using private markets offerings more commonly. I do have concerns about that regarding the liquidity risk. No matter in what kind of structure, you know, a private equity vehicle is brought to market, you know, it's still an illiquid asset. So you need to be mindful about some of the trade-offs you are taking if you do want to sell that position. And particularly, you know, with the listed vehicles that are coming to market, you do need to be aware that those kind of strategies can trade at significant discounts to NAV. So it may not always be easy to get out when you want to, or more importantly, kind of when you need to. So you do need to keep those risks in mind and things we do need to remind our clients about.
Tim, maybe on that one.
Yeah, I mean, I think it's certainly, I mean, yeah, growth of private assets and liquid assets definitely been a trend. And, you know, there's clearly been a role for that at the large institutional level. I do worry somewhat about how that's getting packaged down and componentized to try and fit into some of the issues that you have in putting in a unit trust that's widely available. So that, you know, I don't think it's necessarily as easy to say, well, the large industry super funds have had a great experience doing this, therefore that we can just copy and paste that over here and make that available and achieve the same things for advisor portfolios. I definitely don't think that's the case. So we're sort of, we've done a fair bit of work on that area and certainly maintaining a healthy eye of skepticism, it's fair to say. But I think, you know, at the same time, you think the type of investor that's more likely to use, you know, a private equity fund in a portfolio is going to be a higher risk investor, right? And so to the extent something goes wrong, it should be able to, you know, tolerate that. We probably worry more about, on the conservative end, sort of the credit risk that I referred to. So where people are conservative, you know, investors, and therefore, you know, capital preservation is an overarching consideration, but necessarily, you know, worried about, or focusing probably too much on cash rates and bond yields and chasing credit risk at that end and exposing themselves to, you know, potentially drawdowns they can't afford. That's probably where we spend more time worrying at the moment, I'd say.
And Stephen, on that one?
Well, not a lot to add that I can say after that particular one. I mean, we have looked at those spaces, like those less liquid spaces in a managed account format, but, you know, we typically shy away from recommending them for the reasons we've just spoken about. There's nothing wrong with those strategies if you've got the right structures and the right timeframes, but certainly in a managed account, you don't want to be using those structures and find yourself stuck in them, which then causes the whole thing to lock up. So we're mindful of that, and we certainly agree with Tim in terms of the credit risk. We certainly see people reaching for yield. You don't want to be reaching for yield, or if you are, be aware of what you're doing when you're doing that. So there's no free lunch, as they say. You can't just get extra return for nothing. So you just need to be aware of that.
Maybe on the flip side, how would you, in terms of in your view, from a client or advisor's perspective, how would you get comfort or conviction around an alternative manager to begin with, given that there has been a lot of false starts or false dawns with some of the funds that launches that have actually had stellar track records in the past, but that really failed to underperform or outperform pretty much from there. How do you get conviction in general when you're looking at strategies like this?
Yeah, it's a tough one. As long as you're directing that question to me, Daniel. But in terms of
everyone,
we're all part of a research team, so research houses. So we all have big teams that go out and do DD, very considerable DD for against these strategies. So I think as a retail person, you'd probably find that very difficult to do to the level of extent that we would do it, or our teams would do it at our point. They'd spend 10 hours with some of these strategies trying to get their heads around sort of what does it mean, and what are you trying to achieve, and all those things, and looking under the hood. And then we go and have a look at the returns. It's important to go and understand sort of have there been changes to the strategy that might have mean that it's not going to perform the way it did. You're not always going to get it right. That's the reality, though, Daniel. Sometimes you are going to say, okay, that looks great, everything lines up, and then it just doesn't perform. And that's why you have to continuously monitor and have a look at sort of, is it performing to expectations? But that's like any investment, to be honest. So I wouldn't be too harsh on alternative managers. Like, there's lots of those managers that have done well and previously come out to the market and then not perform to expectations.
And Deanne and Tim, on this one, from your views in terms of getting conviction in general with some of these types of managers.
Yeah, exactly right. We rely quite heavily on our research team to do a lot of the groundwork and really go through it with a fine-tooth comb. I guess some of the things I'd consider probably more in depth than they would in terms of, I guess, traditional asset classes would be things like perhaps operational risk. A lot of hedge funds have historically blown up because of things that are going wrong in the back office or the middle office rather than the investments themselves. So that's probably something they go a little bit deeper into than perhaps they would normal or traditional asset classes. But the track record is important, and it's really important to understand, how that track record has evolved as well. I mean, has that track record been delivered in a time that was just very beneficial or had a really good tailwind for that strategy, or is it something that they can deliver going forward as well? So they're probably two additional things that we'd certainly focus on within the alternative space. Also, the other one would be just making sure that those managers really do have that skin in the game and that alignment of interest as well. I think that's critically important in terms of hedge funds in particular, where you're relying on that manager's skill to drive returns.
And Tim, just anything to add around that in terms of conviction, some of these things, if you were to.
Yeah, I mean, it's hard to get conviction, right? And I think the diligence or the due diligence required to get that comfort is certainly significant, and we definitely attempt to undertake that. But you look at it, a lot of the strategies you find will come to market on track records that were on small assets or in different legal structures that aren't scalable, that don't necessarily or aren't likely to work in an Australian context. And so by the time you sort of go through that process, I mean, there's now, as we sit here right now, there's more fingers on my right hand than there are alternatives funds with positive ratings from our research group in Australia. So that probably gives you an indication of how hard, both how high, I guess, our diligence process is and how hard it is to find managers that we think can actually, therefore offer something through that.
I guess it's so important that, the reliance on research teams and houses like yourselves that you work in is so important. And I guess more broadly speaking, and reliance on research in general is very important in this space. And I think that really probably sums up for a number of clients and advisors that are looking into these if they choose to have them in portfolios. I think this leads us to the end of the presentation. I might invite Toby back. I wanted to say thank you to all the speakers as well. Toby.
So look, from IMAP's point of view, Daniel, thank you for hosting this series of 3 very interesting webinars. and to Stephen, Tim, and Deanne. Tim, incidentally, is the only person I know who's got 27 fingers on his right hand. No, thank you very much for what's been a really interesting and happily quite different approach to the issues of dealing with alternative investments, dealing with investments that are outside the mainstream, and trying to combine them or consider using them in portfolios designed to address the goals of the very varied range of retail investors that each of us as advisors or licensees, portfolio managers has to come to terms with. So thank you for joining us today. To Daniel, Stephen, Tim, and Deanne, thank you for your time today, and to our previous presenters, thanks very much. I hope you've found this worthwhile. We look forward to you joining us again at the awards on the 25th of August, at our State of Managed Accounts webinar on the 15th of September, or at Independent Thought, the chance to take the sorts of thinking that we've heard today and showcase it in a broader context, because as I mentioned before, to my mind, this really is the cutting edge of retail portfolio management implemented advice. So thanks very much, and we'll look forward to you joining us again in the future. Thanks, guys.
Yeah.
Thank you.